Functional Area 3, Part 4, Benefits and Leaves of Absence. Partial wage replacement programs are designed to help employees that miss work because of an injury or illness to themselves or a family member that a doctor or medical provider certifies that the employee is unable to work and therefore causing the employee a loss of wages. California's partial wage replacement programs include California State Disability Insurance, Paid Family Leave Insurance, Unemployment Insurance, Worksharing, and Workers' Compensation. Wage replacement is determined by calculating wages earned during an individual's base period. Weekly state disability insurance and paid family leave benefit amounts are calculated using this base period. Your benefit amounts are based on the quarter with the highest wages earned within the qualifying base period. This base period covers 12 months and is divided into 4 consecutive quarters of 3 months each, as seen on the chart below. Depending on when the claim is filed, the wages an individual was paid in the previous schedule are included in the base period. For a claim to be valid, an individual must have wages in their base period. The wages must have been subject to the SDI tax to qualify. The base period does not include wages paid at the time an individual's disability need to be off to provide family care or to bond with a new child begins. Most California employers are covered by California State Disability Insurance, or SDI, which is funded by a payroll deduction from employees. In the event that an employee finds themselves disabled or unable to work their normal schedule, SDI benefits can be used to offset some of the reduction in pay they will receive from a reduction or complete stoppage of work. Employers that may not be covered by California State Disability Insurance include individuals performing ministerial duties, school districts and local government personnel, state employees, individuals who rely on prayer for healing, and individuals performing domestic services. Benefits are payable for a maximum of 52 weeks. For claims beginning on or after January 1, 2018, weekly benefits range from $50 to a maximum of $1,216. Your weekly benefit amount is approximately 60 to 70% of wages earned 5 to 18 months prior to your claim start date. To receive SDI benefits, the individual must file a claim for DI benefits using SDI Online or a paper claim form. They must serve a 7-day non-payable waiting period, have at least $300 in wages that were subject to SDI contribution during the 12-month base period, have a physician or practitioner certify the disability by completing a physician practitioner certification. If an employee is utilizing sick time benefits to offset their loss of wages, the amount of sick time pay will be considered wages and will reduce the employee's SDI benefits. Employers can require, or the employee can request to use accrued and unused vacation time without reducing their SDI benefits. There are 3 disability insurance plans administered by the Disability Insurance Branch of EDD. The state plan, which covers the majority of employees, a voluntary plan, which can be established by the employer and the majority of the employees agree, or an elective coverage available for small business owners or self-employed individuals. Although the administration of this benefit is through EDD, employers are still required to inform employees of their rights, make the proper payroll deductions, submit the money to the state, and file the required reports. Employers can be liable for penalties if the information or withholding provided to the state is incorrect. For more information about California State Disability Insurance, employers should visit the California website at edd.ca.gov/disability/about-DI. Employers working for public agencies are not entitled to income reimbursement through California's state disability insurance program. However, they are entitled to up to 1 year of paid leave because of a disability. This paid leave will continue for 1 year or until the employee is considered retired and receiving permanent disability pension payments, whichever comes first. All employees are covered by paid family leave or PFL benefits and can receive partial wage replacements for up to 8 weeks in any 12-month period. To be eligible for PFL benefits, an employee needs to be unable to work or only able to work a reduced schedule because they need to care for a seriously ill or injured family member or to bond with a newborn, newly adopted child, or newly placed foster child. Benefits typically equal 60 to 70% of an employee's earned wages in the highest quarter of their base period. The employer can require their employee to take up to 2 weeks of accrued and unused vacation or paid time off before utilizing PFL. Or employees may elect to use accrued vacation or PTO to supplement their PFL benefits. This is called integration. Combined PFL benefits and paid leave can be up to 100% of normal wages, but cannot be more than normal wages. If the employee is receiving benefits from SDI, unemployment compensation, or workers' compensation, they are ineligible to also receive PFL benefits at the same time. The employer must provide notification to all employees, deduct proper withholdings, and submit to the state file reports to the state and properly track the time employees use under PFL. In addition, it is important to know that interactions between state disability insurance and paid family leave for pregnant employees, an employee out on PDL can collect SDI benefits during this time. Once she is no longer disabled because of her pregnancy, she will stop collecting SDI benefits and can receive PFL benefits while on CFRA. The Employment Development Department, or EDD, provides all posting and notice requirements for employers pursuant to SDI and PFL benefits. Employers are required to post the notice to employees in a prominent location that is normally accessed and easily seen by all employees. The California Tax Service Center requires that upon date of hire, employers are required to provide to all employees DE 2320 for your benefit, California's programs for the unemployed. The Employment Development Department requires that when appropriate, employers provide to all employees for your benefit, California's programs for the unemployed, disability insurance provisions, and paid family leave brochure, explaining the employee's rights under all of these programs. Employers are also required to provide employees requesting leave to care for a seriously ill family member or to bond with a new child the paid family leave notice. It is the requirement of the employer to keep appropriate documentation and records pertaining to all leaves and in addition to time off under SDI and PFL. The appropriate reports with regards to wages provided to employees who are taking advantage of SDI or PFL benefits should be filed with the EDD when requested, as these wages may adjust the benefits offered through these programs. The complete listing of documentation and record retention requirements is listed in the Employee and Employee Relations section. The Unemployment Insurance Program provides financial assistance to individuals who are temporarily out of work through no fault of their own. In California, this program is financed entirely by employers. Employees are eligible for unemployment benefits when they are terminated through no fault of their own, meaning the employee is terminated at will or during a layoff, they may be eligible for unemployment benefits. Conversely, if an employee quits or is terminated for cause, they should not be eligible for unemployment insurance benefits. It is important to note, however, that under the California Unemployment Insurance Code 1256, an employee may be deemed to have left his or her most recent work with good cause if they left the employer to protect his or her family or himself or herself from domestic violence abuse. Therefore, it is important for employers to understand how the unemployment insurance process works, as all terminated employees are eligible to file for unemployment, and it falls on the employer to provide the information necessary for the board to make proper determination as the claimant's eligibility. When employees file for unemployment benefits, they must provide to EDD information about their last employer. EDD and the employer then become partners who work together to exchange information that is necessary in determining eligibility for unemployment benefits. The information is gathered through various notices and forms that are time sensitive. The notices are the primary method by which employers can provide eligibility information to manage their reserve accounts and assist EDD in making proper eligibility decisions. The first notice an employer will receive is the Notice of Unemployment Insurance Claim Files. This notice is mailed to the very last employer when a claim for unemployment benefits is filed. It provides general information about the claim, including the reason the claimant states they are no longer working. This is the first opportunity the employers have to provide eligibility information by responding in writing and mailing the response of the notice within 10 days of the date located at the top of the notice. A timely employer response guarantees a written notice of determination and ruling from the EDD and the employer's rights to appeal the EDD's determination. Once an initial determination has been made, the employer will receive the Notice of Determination ruling. This notice advises employers of the EDD's decision regarding the claimant's eligibility for unemployment. It provides a reason for the decision, the applicable section code of the unemployment insurance law, charges to the employer's reserve account, and appeal rights. Appeals must be in writing and received within 30 days from the mail date located at the top of the notice. If unemployment benefits are awarded, the employer will receive the notice of wages used for unemployment insurance claim. This notice advises employers of the percentage of benefits chargeable to their employer reserve account. This is the second opportunity for the last employer and the first opportunity for any other base period employers who were not the last employer to provide eligibility information by responding in writing and mailing the response within 15 days from the mail date located at the top of the notice. Employers can request a ruling to have the liable charges relieved from their reserve account with EDD, and EDD will determine whether the charges are assessed. There are also instances in which employer may receive notification from EDD in request of information. Situations where a current unemployment benefit recipient begins employment with your organization, or when a current employee both works for you and received unemployment benefits for the same weeks. When this occurs, the organization may receive one of the following: a new employee registry, or a benefit audit, or a request for additional information. In any instance, employers should be quick to complete and return any information that is being requested by EDD. In most circumstances, the provided information is being compared to both information received by the claimant as well as the organization's own payroll records to make a determination. The more information they have at any step of the process, the better. Senate Bill 271 ensures full access to California's unemployment insurance, state disability insurance, and paid family leave benefits for motion picture production workers who are residents of California and work out of state on productions, as long as the employee is hired and dispatched from the state and intends to return to seek reemployment. The Worksharing Unemployment Insurance Program allows payment of benefits to employees whose hours and wages have been reduced. This program was established by the California legislature to help employers avoid some of the burdens that accompany a layoff situation, and is considered an alternative to layoffs. Any employer who has a reduction in production, services, or other conditions that cause the employer to seek an alternative to layoffs can consider participating in the work-sharing program. As with other wage replacement programs, there is a 7-day waiting period before benefits kick in. The advantage of work-sharing includes allowing employers to retain trained employees until business conditions improve. It enables employers to avoid the expense of recruiting, hiring, and training new employees. It minimizes or even eliminates the need for layoffs and accompanying hardships for the employees, and it can be used to prevent layoffs in almost all types of business or industry. Employers must meet all program requirements to be approved by the Employment Development Department to participate in the work-sharing program. Leased, intermittent, seasonal, or temporary service employees may not participate in the work-sharing program. Corporate officers or major stockholders with investment in the company may not participate in work-sharing program. The work-sharing program cannot be used as a transition to a layoff. This concludes Functional Area 3, Part 4.